Good morning, everyone, and welcome to our Saxo's Global Daily Markets call. Before we proceed, let me give you a quick heads up. We have a technical analysis webinar by Kim Larson today at 1:30 CET, where he will present you the new tool that we have on our platform, Auto Chartist. Please don't miss this opportunity. You can sign up for the webinar by this link. And now we proceed with Asian session update from Shiyun in Singapore.
Thank you, Akmal. Okay, good morning, everyone. Following overnight negative sentiments after U.S. equities dropped the most since November's presidential election, Asian stocks tumbled with MSCI Asia Pac Index falling 1.5% today, ending a streak of gains in 8 sessions, with financial and commodity shares leading the sell-off. Weighing on the market sentiments were mainly concerns that Trump's pro-growth policies will not pass Congress, and oil prices have slumped to the lowest since November after the latest API report showed a rise in stockpiles last week. Among Asian markets today, Japanese stocks took the greatest hit as both Topix and Nikkei fell sharply, logging losses of more than 2% as yen held on to its gains. It is good to note that Nikkei is now trading very close to psychological level of 19,000 and its 100-day moving average. And given the implied volatility of Nikkei jumping the most since US election, we may see wider swings in the coming months. Lastly, while the second worst performing index, Hang Seng, slipped 1.4% today, one of the Hong Kong property stocks, Henderson Land Development, bucked the overall downtrend and rose 1.2% after announcing a profit that beats analyst estimates and proposed bonus share issue. And that's all from Asia, and passing on to the next speaker.
Thanks. That'd be me, John Hardin, FX. Good morning, everyone. So yeah, as covered there, the risk off is directly linked to frustration over the so-called Trump trade, which I think also feeds to a degree into the global reflation trade, so it's having global consequences. We're seeing a general de-risking, de-leveraging across the board. Of course, the sticking point is this healthcare bill, Obamacare repeal, a bill that's getting bogged down in Congress, where a number of Republican House members are lining up against it. I'm not sure what the progress will be. Is theoretically a vote on this tomorrow, but of course that can get changed if there's some kind of last-minute rewriting or whatever. But also, it has to pass both houses of Congress. So even if it does pass the House, it could face a tough test in the Senate, where the party balance is even more much finer than it is in the House, with only a couple of more senators than on the Republican side than on the Democratic side. So it just leads to the whole anticipation around forceful new Trump policy after the election getting delayed, especially on tax reform and things that would be more dollar positive. So we saw the dollar weaker, but mostly concentrated in the G3 and against sterling to a degree. And really, it's mostly about the Japanese yen. And that's what I'm showing here. The dollar yen did drop quite strongly, as you would suspect, when U.S. rates are headed sharply lower. And the yen is very sensitive to risk and to the combination of risk off and lower yields. Against less liquid currencies, against EM, even though this is nominally a dollar negative development, because it's linked to risk and to the whole global reflation trade idea, the dollar actually progressed stronger against these currencies. So keep that in mind. Correlations could surprise here a bit, and the whole idea of risk on, risk off changes the playing field relative to the environment we were in when everything seemed so quiet recently, after that remarkable string of, for example, 1%, no 1% down days that we saw recently. So the question from here is whether this deepens. Of course, the bill failing in the House could see a deepening. I think a lot of this is simply about raw sentiment anyway. And in an environment where we've seen a tremendous up-leveraging and complacency, sometimes the risk is for these moves to play out rather quickly and for the volatility to remain high, even if it doesn't last for very long. So just let's keep our hats on here, helmets on for possible risk off to extend a bit. And here you're seeing an Aussie dollar even among G7, Aussie not able to rally against the dollar, even with a nominally dollar negative story, because it impacts the whole reflation trade. As well, we actually did see a news item out of China overnight about some banks requiring injections of funds. That looks a bit dodgy in terms of their financial system stability, so keep an eye on that as well. Key events for today: the RBNZ is the big focus tonight. Minor U.S. data and a couple of central bank speakers not likely to move markets, as it's all about the progress of Trump as we look towards that House vote tomorrow. And yeah, that's going to be the big focus. The energy level is certainly much higher markets than I would expect. It'll take a little time here for volatility to die back down again. So let's all be careful out there, and I'll pass it along. Thanks.
Thank you, John. Peter here in equities. So yeah, as you can see to the chart on the right side of the slide, you can see that's the biggest drop since October, and going even further back when we had that hawkish Fed announcement back in the beginning of September, where they hinted that they were going to hike rates last year. So we are finally waking up to some reality here in equities. We have been shouting a little bit about it lately in some of our various presentations. Credit growth have really slowed down now in the US. It's only been up 3% over the past 3 months and really coming to a stall here. And you have basically banks sending a small warning signal the days before yesterday. Shares were down 3% yesterday, and it's now down 8.2%. So you already began seeing the slide there. I think really it's the reflation trade that is coming off here, specifically in the banks. Obviously, the banks will benefit from higher rates, and higher rates have to come with higher inflation and higher economic growth, and that seems to be the story that at least is ending here short term. So we are definitely cautious here, and I would not be surprised to see global equities continue down and make a full correction of around 5 to 7%. And as John alluded to, I think in this environment, it's not that we have a major catastrophe on our hands, so it will probably be a healthy technical short-term correction, and I think it's the right way because the narrative is changing. It's not longer the pro-growth Trump policies. There will be much more bumps on the road, and then the S&P 500 really broke through down through that 2,350 key level that we had been mentioning for several weeks. Also, Nikkei broke out of a very tight range. We had an upward move in the VIX and credit as well. We had FedEx, a global barometer of e-commerce and logistics in general, missed their estimates for the second straight quarter. They maintained their fiscal outlook, but I think there is still downside risk to that fiscal outlook, even though we only have 1 quarter left of their fiscal year. But definitely, it's not an upbeat tone from FedEx here, so that also spills into the negative sentiment. The slide here is just, as you know, we put out a long puts trading idea on the S&P 500 Wednesday last week. It's on trading floor where you can see all the parameters, and basically the green line on the chart to the left is where we got in on that put. And as you can see, it's really moving now in our direction. And to the right, you can really see the breakdown of the tight range we have been in. And I would not be surprised to see, as I said, global equities to continue lower here. So, and with that, I will give the word to Ole on commodities. Thank you very much.
Thank you very much. Staying on the equity theme, we've seen the banks being under pressure, as Peter mentioned. The question is if we could see the energy stocks come under some pressure as well. We are seeing some renewed weakness in oil prices yesterday. We have been in a range. We were looking for the market to establish a lower range. We've seen much of the speculative froth has been removed. But at this stage, with OPEC probably more and more in need of extending the production cut deal into the second half, it is basically fraught with difficulties because they need non-OPEC participants to be on board, and the question is whether Russia is going to, who's yet to commit to 100% to the cuts during the first half, whether they will agree to an extension when we know companies like Rosneft, who's accounting for 40% of Russian oil production, that they have in their statements said that they're planning to increase production. So it's a bumpy road still. Today is going to be another critical one. Inventories from the EIA. Yesterday's the API rose more than expected. We're looking for a 3 million barrel rise according to surveys this afternoon. That will bring inventories to a new record, just to give you some idea about what we're looking at. So 3 million, which is a reversal of the small reduction we had last week. So at this stage, we're seeing gasoline being supported by falling inventories, but crude oil is still seeing inventory rises, and we could hit a new record. Also keep an eye on production, which continue to rise. We also need to keep an eye on the imports from OPEC, because that needs to continue to slow, because that will be the impact of the production cuts. If it doesn't, then that will also be taken negatively. There's a report out from Goldman Sachs yesterday. They're basically saying that multi-year projects, which was started 5 to 6 years ago, which is normally the time it takes for these multi-billion big projects to come to fruition, that we're going to see supply from these projects over the next 2 years. And combined with that, they're seeing shale oil production potentially rising by 1 million barrels a day from 1 million barrels a year from 18 and onwards. So again, plenty of negative news on the supply side to keep the market under pressure. So for today, the key really is 50 in Brent crude. We're currently trading 50.70. It's the uptrend from the lows last year. We also got some 200-day moving average coming in here. If we start to break, then the market will start focusing on an extension down towards 46. So we are neutral at this stage, but again we have to turn increasingly bearish once again if the market breaks below 50. So a challenging day ahead. Gold is receiving what could almost be a quadruple boost from the events over the past 48 hours. Lower stocks, lower dollar, lower bond yields, and renewed risks related to Trump's policies in the U.S., all adding support to gold. It's not a runaway train at this stage. We have seen investor sentiment being relatively skeptical. There was a big reduction ahead of the FOMC meeting last week. They are getting back in. CTAs who are break momentum traders, they have to buy at these levels. And at this stage, the market is targeting the February high a bit higher from where we are at this stage. On the other markets, as I mentioned, sugar remains short. The breakout model went short the other day. Gas is we're long natural gas above 312. Copper is under pressure from potential end to the supply disruptions, and also the increased risk that the Trump's infrastructure pledge is going to run into the sand if you can't get stuff through Congress, and that's putting copper on some renewed pressure. The breakout model has been long since 227. They are going to exit at 255.80, and that's undoubtedly also a level where we'll see new short start to come in. So that's a level to keep an eye on the downside. That's it for me. Over to bonds.
Thank you, Ole. Treasury is also catching a bit here on the change in sentiment. If we look at the 10-year yield in the chart here, that means we are down to 2.4% for the 10-year yield. So could likely target a move down to the bottom of this trading range that we've had for almost half a year now at 2.3%. If we look at Europe. The talks about a potential deposit rate hike is still gaining more and more traction, and it's very likely that the central bank is sort of testing the market reaction to this idea. So the dominating theory right now seems to be that the ECB could announce further tapering of QE from starting from December, together with a small hike in the deposit rate of maybe or in the range of 10 basis points. It's primarily the short end of the euro curve, which is on the move. 2-year German Schatz is all the way up to minus 0.7%, and it touched minus 1% a month ago. So it's rallied almost 30 basis points, which is quite significant in the short end there. Bunds, the 10-year long end of the curve, is a little less moved. Still trading here at around 43 basis points for the 10-year yield. Relatively to treasuries, that obviously means that it's outperforming the spread between these two, Germany and the US. The Ryder Cup spread for the 10-year is below 200 basis points, and that's actually the first time since November last year. Inside the Eurozone, France is seeing some strong performance. Still relatively to historic levels, it's pretty wide to Germany at 63 basis points. Italy and Spain also seeing some demand here as the Le Pen fear trade is taking a step back. Another outperforming segment is the emerging markets on the back of this drop in US dollar yields. Some parts it's been strong for quite a while. In Argentina, where there's really a significant shift in policy towards more business-friendly and more investor-friendly policies. And this is the subject of our weekly bond update, which will be out on tradingfloor.com in a few hours. So make sure you look out for that. But we can see that bonds have been performing quite strong this year in Argentina and other parts of emerging markets as well. But that's it from us today. I'll pass you back to Akmal.
Thank you, Michael, and thank you all for joining us today. Please don't forget to check out our webinars page by this link below. And we go live again tomorrow at our usual time, 8:40 CT. Safe trading and have a nice day. Bye-bye.